Mishcon Academy digital sessions.
Good afternoon, everybody. My name is Ross Bryson. I'm a corporate partner at Mishcon Academy, and today is one of our Digital Academy sessions on raising finance during COVID times. I'm going to be joined today by some of my colleagues on taxation. We've got Gary Richards for private equity. I've got Andrew Rimington joining, and we have Sarah Sperling speaking on all things banking and finance. It's a critical topic at any time of the year, and of course, especially so during the cash flow and working capital crunches that everybody is facing. We know that some 35 billion of government funding has been lent to date into three of the key government loan schemes: the Bounce Back Loan, the Coronavirus Business Interruption Loan Scheme, and the Large Business Interruption Loan Scheme. But not everybody can access those schemes. We also know that over the next 3 months, companies are going to face a cash flow crunch because the furlough scheme will be coming to an end in about 3 months, and also businesses will be looking to reopen. So in this talk, we're going to look at different sources of funding. We're also going to look at the government schemes, including the grants and rebates and loan schemes. But before we get there, what I do want to do is start with looking at some ideas as how to preserve cash and protect working capital. At this point, I want to bring in Gary and speak to you about your thoughts on time to pay agreements and other ways maybe to have a dialogue with HMRC, which can help in these times.
The first thing to think about is the time to pay scheme. Essentially, you ring up HMRC and you put forward a case as to why you will be able to pay the tax, but not all yet or not as quickly as they would like it. And if they're convinced, they'll probably agree a plan with you to pay the tax. The other thing is a really practical point to do with corporation tax. Companies pay tax by reference to accounting periods. If you're going to have a lot of tax to pay in a few months' time, and your accounting period ends, 30th of April, if you instead closed your accounting period, end of October, you'd have tax to pay a bit sooner, but on a much shorter period, and the rest of your foreshortened accounting period, the tax will be payable quite a lot later.
So in terms of other ideas, Sarah, what have we got? If you're out there and you're trying to avoid taking a loan, what can you do with your banks?
Most businesses will already have instinctively gone back and had a look at their existing financings to see what they can do, what they need by way of concessions, accommodations. The good news is that most lenders are showing themselves to be reasonably supportive of their existing customers. Another thing that you can look at is a debt for equity swap, which is perhaps more traditionally in a kind of group context, but it is possible for a third party finance provider to decide to convert their debt to equity. And then in terms of cash flow, you might want to look at looking at the assets within the business that might be available for leveraging. And a classic example would be factoring. And in that situation, you can go to a factor, effectively the lender, who will provide upfront funding, typically around 80% of the value of the invoice on the date the invoice is issued. It means that you can use that invoice to get cash in at an earlier stage, and obviously that cash can be used to keep business going.
All right, so having considered ways to preserve working capital and protect cash, turning to the government funding schemes, there are various which are grants and rebates as opposed to loans. And in that respect, what schemes have we got out there? Andrew?
There's the Small Business Grant Fund. If you occupy premises and the rateable value is less than 15,000, you should automatically be eligible for a grant of £10,000 from the local authority. Likewise, in the hospitality retail sector, there's a similar fund available of up to £25,000 that again is linked to the rateable value. We're encouraging clients to make sure that they've looked at all of the grant funding options before looking at whether the business interruption loan scheme, etc., is available as an alternative.
So along this line of government schemes, there's obviously the Future Fund, and I wanted to raise the Future Fund as a concept. And the Future Fund is a matching scheme whereby the government will put up 50% of what you'll get from a private investor up to 5 million. So it really is only appropriate for high growth companies. Andrew, if I can come back to you briefly, just to what extent is private equity a realistic option right now?
Equity is a very scarce commodity, and give it away, as a last resort. And therefore, to the extent there are business interruption loans available, make sure you've exhausted those first. And I think probably, Sarah, it's probably worthwhile you just talking very briefly on the SME scheme and the large company scheme.
The two business interruption schemes offer business loans, overdrafts, invoice finance or asset finance. The government provides the 80% guarantee, and for smaller loans will cover the first year of interest and fees. The business needs to be able to provide evidence that it's been negatively affected by the coronavirus pandemic. Generally speaking, they can't have been a business in difficulty, and they have to derive more than 50% of their income from trading activity. In the guidance for the loans between government and lender, it's made very, very clear that the lenders are the ones responsible for making the judgment. Most importantly, the lenders have to look at the business and the loan proposal and conclude that, but for COVID, this would be a viable business. And so it's really important when you're applying for those kind of loans to make sure that that short, medium, long-term business plan is there and stacks up and is presented well. From what we have been told by lenders, one of the huge problems that's facing the scheme as a whole is the sheer volume of applications that have been received. For the smaller of the two schemes, something like 9 billion has been advanced so far. That's around half of the 90,000 applications that have gone in. For the larger one, it's more like 1 billion and about 190 successful claims. So that gives you some sort of idea of the scale of what's there. It's perhaps not that surprising that the businesses that are able to put forward a very, very strong case are the ones that are going through a bit more quickly.
On Mishcon's website, in its COVID page, there is a checklist of all of the government-funded grants, rebates, loan schemes, which is updated quite regularly to pick up all of this. So moving away from the government schemes and then again moving back into what else is out there, what other options might people have? The concept of sale and leaseback potentially has popularity in times of need.
It's certainly an option for a business that owns its own offices to look at doing a sale and leaseback to try and get some of the equity out of that property. The business sells their property that they own to a willing investor. They remain in control of it, in control of their property expenses, but they have the benefit of obviously getting the liquidity from the sale of the property.
Bringing in a slight public company side to it is the so far untested, I believe, IPSX, the International Property Stock Exchange. If you have a property of investment grade value, which I believe is 50 million or more, at a single geographic location, so say a football stadium or a large office building, the idea is you drop that into a new propco and you list the propco. We've also got the concept of peer-to-peer, which in terms of companies that have spare cash, lending that money to companies that don't have the cash. But have you guys come across this or people asking you about this?
In spite of all the doom and gloom in the media, founders are continuing to raise money and convincing private equity and venture capital to make investments. You should have a dedicated COVID-19 story. Showing potential no longer gets you a seat at the table. If you can show resilience in spite of COVID-19, then from an investor perspective, you're far more resilient in terms of process. In any time of recession, what you see is that the valuations take a dip as a result.
But Gary, if I bring you in there, there's also the concept of inheritance and wealth transfer. It can be tax efficient to actually take some of your inheritance earlier.
The point we're making about inheritance tax is just a really simple point. If you've got parents who, perhaps because of COVID, are reminded of mortality, is it now the opportunity to pass on funds, whether by way of an equity investment, possibly by way of a loan on favourable terms? Because if they survive long enough under current inheritance tax rules, the cash moves out of one generation essentially into another.
There's also the concept of mini bonds, which can get a pretty bad press because when mini bonds don't go well, then there's people who are left out of pocket. The concept of mini bonds is an interesting one. Again, it's a version of crowdfunding, and there's many different versions of that.
If you come to a decision that you are going to need to look at third-party capital raising, be realistic about pricing, but also, target the raise. Is this genuinely a bridge round? Are we talking about a growth round? If you are in the fortunate category where you're the kind of business that is continuing to generate increased revenues in spite of COVID, then don't just take the first person that offers cash. Go for smart capital, and be very careful about giving away dilution.
And in a longer term view, there are apparently 300 incubators and accelerators scattered across the UK. MDR has its own law tech incubator, MDR Labs. If you go to the British Business Bank, it splits its website into startups, scale-ups, and stay ahead. And it's got a finance hub, and it has an interactive finance finder tool where you can put in your location and the stage of finance you're at, and it will give you a drop-down list of a couple of hundred potentially of finance providers who might be suitable for you. There's also on the UK Gov website, there is a finance support page. One of the things I also wanted to mention was the concept of patient capital, and the British Growth Fund as a kind of primary example of this. And the British Growth Fund was born in 2011 off the back of the last financial crisis. It takes a minority stake, and it doesn't go through funding rounds which give a pressure for exits. It's invested in over 300 companies and £2 billion since 2011. And they will co-invest alongside private equities. With that, Sarah, on asset-backed lending, there are also the possibility of maybe releasing the equipment that you've got and borrowing against that.
Lots of businesses in the manufacturing sector rely quite heavily on that, because they can have really significant valuable pieces of plant and machinery that they need for their business, and if they can use that as an asset against which to raise finance, it enables them to sort of improve their liquidity. You tend to find that ABL lenders will be slightly more willing to lend into a business that might be potentially in financial difficulties than a traditional lender.
And so I wanted to invite final thoughts.
From a tax perspective, is think very carefully about the terms of any particular equity you're going to issue now, as to, is it going to prejudice someone's who's previously had tax relief, and will that equity raise now have an implication on how much you can raise in the future? Some of these tax schemes for the government are really quite tight to get into. COVID has been expensive and continues to be very expensive for the government. One of the things we need to bear in mind is some of the tax rules we're used to at the moment. I just don't know whether they are going to survive longer term whilst the government rebuilds the public finances. If you've got any big tax assumptions underlying your growth modelling, you need to think how realistic those rules continuing to exist will be.
There's a sense that a lot of the debt is going to be converted into some kind of equity, and there's conversations going on around, will there be a new 3i? Because of course 3i was born out of World War II, so it was a decentralised local venture capital government-backed fund, and they may need something similar again.
In terms of roundup from my perspective, through recent months, we've had a number of lenders, challenger banks, bridge financiers, being very clear that they are still open for business to maximise chances. I think it's really, what we are stressing is the importance of doing proper due diligence and understanding what you need and matching that to the lenders that you're approaching, to their risk appetite, to their funding behind the scenes, and then understanding that it is just inevitably going to cost more in the current climate, and it is going to take a bit longer.
Historic timetable lead times from the date of the first contact with a potential source of funding and the date when the funding actually arrives is inevitably going to be longer. So definitely encourage people to think about what happens when the money runs out and not wait for it to run out before asking the question.
Well, look, time's up. So thank you to Andrew, Gary and Sarah for joining in. Otherwise, thank you to all the attendees for listening in, and stay safe. Goodbye.
The Mishcon Academy Digital Sessions. To access advice for businesses that is regularly updated, please visit mishcon.com.